Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist, and six-time author and fiduciary, Tony Walker.
Well, welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, retirement planning specialist and full-time fiduciary, Tony Walker. And I want to take you down memory lane just a little bit. You know, as we record this show in June of 2025, I have literally been on TV since the mid-90s. And it's kind of funny how things run. So back in the 90s, I had a show called Your Money Matters. That was on for roughly about 10 years, and we covered all kinds of topics back then, investments, insurance, etc. Then we moved over to network television here in Louisville, Kentucky. And for approximately 10 years, I was on network TV every Monday as their featured retirement planning specialist. In fact, that's where I met our own Aaron Orander. So after that gig, myself and Aaron checked out and started the Worry-Free Retirement Planning Show that you're watching today, which has been in existence now for nearly 12 years and recorded more than 570 episodes. Can't believe it's been that many, but what a great ride. Now, with that being said, we're starting a brand new format. We've been experimenting with this a little bit. It's more of a podcast format. And when we get into this format and moving forward, I want to explain why we're doing that. So let's go down memory lane just a little bit, all right? So basically, when I started the show, Your Money Matters, back then we had a total of 3 employees. That's it. And back then, I had just gotten out of the investment world. We were focusing more on insurance, tax planning, estate planning, and things like that, and really didn't have a lot of direction for savers. I knew I wanted to work with savers, but we didn't really have a platform built out. We were starting to work a lot with annuities. In fact, I started doing so much work with annuities. That's when some of my peers dubbed me as the annuity king because of our work there. But then, as we've grown and as we've served our mission of helping more and more savers, take a look at how many employees we have now at Tony Walker Financial. Now, here's where we're different than the rest of the financial herd. We have more employees not to go out and sell more business. We have more employees to service the business that comes in through me. So what happens is you've got the owner of the company with this experience on the front lines who's looking at the situation, sizing things up, and as you're about to find out over the next several months as we work through all of this, how valuable this staff is to Tony Walker Financial in servicing what is brought in through the front doors. It's a unique relationship, unlike anything out there, and you may have experienced that. You know, big firms out there, but they might have 10 advisors and 3 support staff. We have, besides myself, 3 other full-time fiduciaries and then 14 to 15 support staff at all time. Why? Because we want to make sure the service is top-notch. Now, since that time, and we're going to talk about this today, our investment philosophy, we've created something called the split IRA concept, which, quite frankly, is being emulated by much of the financial world. And this split IRA concept gives our saver clients something that most people don't have. That's use, flexibility, and control of their money. A very unique process we offer our saver clients so that they can enjoy this money before it's too late. So what I thought I would do today, we're going to introduce the other fiduciaries, and today the title of our show is literally Our Investment Philosophy at Tony Walker Financial with Your Money. So with us in the studios to explain our unique investment philosophy for savers, I have to my left on the far end there of the table there, my favorite nephew and financial fiduciary at Tony Walker Financial, Wes Walker. Good morning, Wes. And then to his right, my favorite son-in-law, Mr. Trey Juergens, and man, is Aaron and Derek knocking it out of the park with the technology. We might have to have a drum roll here. Do we have Miss Heather Hughes in our Bowling Green office via Zoom? Here we go, folks. Drum roll. Technology works. Good morning, Heather.
Good morning from Bowling Green.
Oh, it's so good to have you. And what I thought we would do, we're going to get into our investment philosophy for savers. But before we do that, because you've been with me now close to 20 years, describe what we were doing back then, and just as I had just given up basically working in the investment world after 9/11, and kind of bring us fast forward to where we are today.
Well, as you just mentioned, the firm was really focusing on insurance, tax planning, estate planning, that type of thing. And then the fixed index annuities really started to take hold and uh, were becoming a presence in the market, and you really embraced that. I think, of course, you weren't in investments at that point because 9/11 hit, and you really felt uneasy about the market when all of that tragedy struck. But then we started kind of getting into income planning and really putting plans to paper and showing clients what they could do with their retirement income. And then we saw that there was really a need for some liquidity in those plans. That's when we really adopted using Vanguard as in our investment platform. We soon outgrew that, and you're probably going to get to that in just a moment. And then eventually in 2017, uh, moved to Charles Schwab, where we have just thrived.
Very good. And start over. And speaking of investment philosophy, I know Wes, you work very hard on this. You and Trey. Sometimes I think the market, I guess, let's say that the market of savers gets a little confused in terms of our philosophy on investments versus the big boys and the traditional way most people do brokerage. So if you would, before we get into our bullet points here, kind of explain what you've seen in terms of the difference between how we manage things and maybe how a typical money manager might manage.
Yeah, absolutely. So our firm is very focused on getting people their money in short order. So a lot of it has to do with if they're needing money now, if they're needing money in the future, and trying to match that sort of time horizon to their risk tolerance. So that's a lot of what we do. Just for instance, if somebody's going to withdraw from an account in the next 5 years, we're going to be very cautious with that money. If they've got a longer time horizon, we might take more risk. I think the traditional financial institution is not really planning things out like that. They're more so trying to create their most efficient portfolio possible and squeezing everyone they can into it.
Yeah. And same thing, Trey. I know you're meeting with a lot of people and you've been now here close to 8 years. What would you say in terms of our philosophy and even some of the savers they might say they want to take some risk, but what would be, let's say, and we'll get into this again in more detail, but our growth philosophy maybe versus another money manager who says this is our growth philosophy? What does that look like?
Yeah, even our growth strategies, the equity exposure is a lot less than what you might see out there in something that's more aggressive with a real active money manager. And a lot of savers have been in the 401k their entire careers, maybe followed a 60-40 of equity and bond or 70-30, whatever it is. Then they come over to us and we introduce them to these different products and options that are not available in the 401k, lay them out, as Heather said, in these income plans, and it's really eye-opening.
So with that said, Wes, again, what we're getting ready to go off these bullet points, why did we come up with these bullet points we're getting ready to feature?
Well, it's important to understand what you're getting into when you get in with a financial institution. What is their philosophy? What are they really doing? I think a lot of different advisors can kind of sell the sizzle of, oh, we know what's going on with markets. We know which way they're going to turn. This document is almost just to say, we have no idea what investments will do generally. All we can do is sort of understand your situation to the best of our ability and then design an income plan for you and then invest your money accordingly. But we're not putting you into 70% equities because we think the equities are going to outperform.
Yeah, speak to that. And by the way, I'm very proud of Wes. I meant to mention this. Wes, and you all know how difficult this exam is, recently passed his Chartered Financial Analyst exam. So you are officially able to use that CFA. So I don't know, Aaron and Darren, could y'all find some crowd noise somewhere to give him a round of applause?
I'll take it, even if it's simulated crowd noise.
But no, congratulations on that. But again, folks, we are committed to the investment world, but we just look at it a lot differently. So let's kind of dive in. And I love this document that all three of you all worked on, but we give this to everybody now if they're considering working with us. And also, Trey, I know when you deliver those binders, or Heather, you are going over this with them just to remind them what our role is. So let's take the first bullet point, the investment platform of Schwab and how we use that with annuities. And I think if you don't mind, I'm going to let Heather weigh in on this. We call this our split IRA concept. Why is this so unique to the industry, and why does this allow us to give our saver clients so much flexibility in retirement?
Well, the split IRA concept is just a really efficient way to deploy money during retirement. The front end is our Schwab bucket for what we refer to. That's our liquidity bucket. So initial income comes out of that. What that does is twofold. One, clients have access to income that they need. And two, it allows us to have the annuity grow and gain some steam over time. Time is on your side with an annuity. Then when we've had enough time elapse, we turn on the lifetime income from the annuity in most situations. So it's really powerful that we've got a platform in which we can handle income needs now and lifetime income later.
Very good. And Trey, it was funny. I had a couple in yesterday and they said, well, watch that show on the other day. I think y'all may even got a calls on this too, where I was comparing yields to payout rates. Explain why we're using MYGAs, multi-year guaranteed annuities, and how that works even with our mailbox money and maybe the difference there. So how yields have been up and that's really benefited us with these particular products.
Yeah, our clients come to us at different times. Sometimes interest rates are in a higher interest rate environment, sometimes lower. And we utilize different products for different reasons. And this client was really impressed by these yields on the fixed annuities you were showing on the whiteboard. She did not have one because she became a client in 2021 when interest rates were nowhere to be found. So she was like, well, Tony told me I should have this type of an annuity. I said, ma'am, no, you have this type of annuity. We want guaranteed lifetime income. And that's a lot of what savers do. They come to us, they go through the process. We identify the needs based on what they tell us. So by finding the correct products, a lot of times people are, why am I not all in Schwab? Why am I not all in annuities? We use a blend of both to kind of identify what they told us they need, and we can satisfy what they need with that income plan.
And we'll speak to that because and it actually has cost us money, quite frankly. If we use an example of 100,000, say we have a Schwab, and let's say for whatever reason the bond portfolio hasn't done well, and maybe somebody's wanting a higher yield. Now we have these MYGAs, and we move the 100,000 out of Schwab to a MYGA. Well, roughly, if we just take 1% as an example, that's $1,000 a year that's off our statement that we don't get in terms of fees. The MYGAs may be paying 2 and 2.5%. It's actually costing us money. But as fiduciaries, why do we do that? Why are we constantly looking out for the client? And as Trey said, depending on what products are doing, because they ebb and flow, our job to find those products that are suited for them at that time.
Well, I think the beauty of our firm is that we're somewhat agnostic in when we select investments. I think we're okay if it's a fixed annuity, a MYGA contract. We're okay if we're going to put money into Schwab or an income annuity. And we don't show this sort of bias toward one product or another, particularly if they're paying a high commission. That is pretty rampant in the industry, that if something's paying well, you might push it more. There's an incentive to do so. So our agnostic approach to picking investments is, I think, a boon to our business.
Can you Google Trey agnostic for me? I mean, no, very good. Good stuff. I love it. That CFA stuff's paying off, as Dick Walker would say.
Yeah. Teach me more words.
Good stuff. All right, let's go to the next one. That was good, though. Actually, I like that. Okay, now the Charles Schwab and the goals that we have for the Schwab and what it is not. Heather, speak to this very briefly. Gosh, we're having people, and quite frankly, we probably did more of this in the past before we had Schwab, but speak to the fact of how many people come in here loaded up with annuities and they don't have liquidity. Explain liquidity in layman's terms and why that Schwab bucket is so important for liquidity purposes in retirement.
Oh, sure. So with annuities, well, for most annuities, they do have restrictions on how much money you can take out. And typically, for a typical fixed indexed annuity, that's 10% per year. Sometimes clients need more money than that. And so to have that extra account that doesn't have any limitation on how much you can take out is very powerful. We often see clients that, especially initially in retirement, they want to possibly pay off their mortgage, or they're in need of a new vehicle, or, life happens. So to have some contingency money freely available to them is very powerful and has been just a game changer, I think, for us with our retirement practice.
Yeah, I would say we're always talking about my late great father and the Dick Walkerisms of the world. He used to always say nothing stays the same, meaning everything changes. I think to me that's one of the greatest truisms in retirement. I mean, you all are on the front lines. How many times, even when we have a plan laid out, have people's plans changed? And so that's the point, folks. You never know when you're going to need money. So again, split IRA, if you don't have something like that, we'd love to show you how that works. Let's keep going. Wes, I know you get this a lot. People think that Charles Schwab is the annuities. And we like to use this example of a supermarket. Explain our relationship with Charles Schwab, because we are not employed by Schwab. We make this clear. They're a custodian. We don't work for the companies. A lot of advisors technically work for these companies. We don't. So how do we explain to clients our relationship with Charles Schwab moving forward?
Sure. So Charles Schwab is a custodian. They hold assets for us. We work for our clients. Our only sort of obligation is just to serving our clients. It's not to serving any, sort of financial institution. But Schwab acts as almost a big grocery store, if you can kind of picture it like that. And we're kind of the nutrition specialist who's working on behalf of the client. So we're going to, to continue the analogy, design a meal plan by picking investments for them, go into the grocery store and determine what low-cost items can we buy that best fit their plan. To relate it to the analogy even more, if you were really on a health kick, you might stay around the outside of the grocery store, getting meats, vegetables, fruits, that sort of thing. You would probably stay away from the inside of the grocery store, the middle aisles where there's all sorts of sweets. And in this analogy, that would be very high expense mutual funds and all sorts of products they don't need. So we can pick those out for them using Charles Schwab.
It's funny, I overheard Derek ask Aaron, why would you ever go around the outside aisles? I think he heads right for the Lucky Charms, apparently, when he goes to the grocery.
There's some sweet stuff in there. I get it.
And Trey, would you like to add to that in terms of also our nutrition idea and how we set up these meal plans? I think that's a good one. I like that.
I'm getting hungry now. But no, I think that's exactly it. The Schwab provides us an opportunity to go and get the stocks, bonds, mutual funds that they're used to within that 401k. So if someone has a little bit of an appetite, if you will, for investing, we can certainly do that.
We can move over to the middle aisle,
exactly,
right?
Yeah. So we've been known you're the annuity king, as they like to call you. So a lot of the times, that Tony Walker Financial, all they're going to do is stick in an annuity, and that's far from the truth.
And let's speak to that. So back to you, Wes. Roughly how much do we have now with Charles Schwab under management? Do you know that number right offhand?
Yeah, the AUM at last tick yesterday was roughly $340 million of assets under management. Now we've got more assets that we've written through annuity contracts, but still $340 million is not a small number.
And so, yeah, we can't call it assets under management. With our new CRM, Heather, I don't know if you're aware of this. Remember, I think TJ got nervous because I stumbled into a report that he said, you're not supposed to be in that part of I think they're worried I'm going to crash the software. But we have under our guys, we'll put it this way, including annuities, over $1 billion. You were aware of that number, weren't you? I think that's pretty incredible.
Oh, I was. And I was also a little nervous when you found that report. So, yeah.
Me and technology don't get along, folks. But with that said, and we talk about this in our Thursday morning meetings, we have all this AUM, but that doesn't drive us. I mean, how much more AUM would we have, Trey, if we really did not encourage people to use and enjoy their money? I mean, really, how much do you think we could have?
Drastically more. And that it is all part of the messaging, the live well, die broke philosophy, using and enjoying your money. The financial world doesn't really work that way. They want to charge fees on that money. If you need a new car, if you want to pay off the house, a lot of advisors are going to talk you out of that because they want to keep that money in the account. And we see it all the time that someone comes to us with these goals in mind and their previous advisor was poo-pooing that whole idea.
That's right.
And we give them the opportunity and the tax advice on how to do it. We pull that off and they become our happy clients.
Very good. And remind me, one of the things we're trying to do, folks, is start a monthly series. So this is all investment philosophy. Next week, I think we're going to talk about, let me see here real quick. I think we're going to talk about the responsibilities of Tony Walker Financial with the management. So that'll be our topic next week. But I think we could do a whole month on cash flow. What is the purpose of cash flow? So just like that, why would, a broker might say who's not trained in the art of retirement planning, why in the heck would you pull money out to pay off your home? Well, it gets back to cash flow. Some people don't want the obligation of the debt. So make a note of that, Trey, because that's probably something we ought to cover. All right, let's keep going. I love these analogies. And again, folks, this is what we have. I guess we could provide this as a download, couldn't we? Is there any reason we can't provide this document as a download?
It's available on the website.
Okay, how would they go about finding this, Trey, if they want to see this document?
It's TonyWalkerFinancial.com. We've got the free downloads on the website. If you go and you just find the downloads page, just your name and email, that opens up any of our free downloads.
Okay, awesome. I would encourage you to get this, folks. And again, we're trying to explain, if you're just now joining us, the difference in the philosophy between Tony Walker Financial and the rest of the financial world. And I might make this mention, we're working with savers. I think that's the other thing. Even our friendly competitors, they don't understand. We're not working for investors and speculators. So these saver clients, whom we know very well, there's a certain thing they need and want, and that's what we're trying to deliver for them. All right, let's get down to this. We have two factors when we're choosing investments, and we'll just go around the horn here and anybody wants to jump in, but we call it risk tolerance and time horizon. So why is it so important, Heather, to talk about risk tolerance with people? And back to Wes's supermarket analogy in the nutrition, how everybody's different in terms of their level of risk and why that's so important to know up front.
Absolutely. So, a lot of times when I'm meeting with clients, I'm in front of them trying to choose what portfolio we're going to invest them in. And I always tell them there's no wrong answer to this. It's where your comfort level lies. Uh, the nice thing about our income plans is we do make lower assumptions on risks, on rates of return. And so I'm comfortable with them choosing any portfolio because I know the assumptions we've made on the plan, we should be able to maintain those for the most part. So we really, if it outperforms our estimation, then, we're in just better shape. And that way we can deal with certainties on the plan. So, it's really comfort level. A lot of times I'll ask a client, it's like, okay, if you see a drop of $2,000 in your account on your monthly statement, what's your reaction? Some clients are going to say, well, the market goes up and down. And some will say, I'm going to lose sleep over that. That's really our indication on where they need to be.
Yeah, Wes, speak to that because we just had a client in yesterday, nice gentleman, been a client for years, just retired, and he was talking about the Schwab portfolio. It's done pretty well, but what were his comments about it going up and down? Did you sense that he just didn't like the thought of that thing going up and down, and how did we respond to that?
Yeah, it gets right back to the same two items, risk tolerance and time horizon. So someone may even have a long time horizon. They might have 10 years. And the financial world traditionally would say you need to be 100% in equities with a 10-year time horizon. That is the most appropriate investment for you.
Because just based on time horizon,
Exactly.
right? Yeah.
But they don't realize that this person, if they see a 20% drawdown, will cut bait, run, and then make that loss realized. So again, even though they have a 10-year time horizon, if they have a low risk tolerance, that person at our firm might end up in a 10-year fixed annuity with zero risk. But it's all about knowing that client specifically and their goals.
And Trey, we just ran into this with a gentleman. He approached us. He's basically truly retired. And this guy's an investor. He admitted it. He said, Tony, I tell you what, I am so tired of fooling the investment world. And I don't think he thought I could do this. And again, folks, we're filming this in June of 2025. These rates change all the time. But this was the other day. He said, I don't know. I was just thinking if I could get 5% guaranteed for the next 5-10 years, I don't know, we can do some business. And I said, are you serious? And he goes, yeah, I'm serious. I said, well, let's do business. He said, what are you talking about? Because he knew in the market I couldn't guarantee that. But with the fixed interest annuities, we could. And back to your point, Wes, from a time horizon standpoint, it didn't matter. He was truly an investor, but he was at that point in his life, he just didn't want to take any risk, and 5% was fine. So speak to that. You see a lot of clients, the same thing Wes is talking about, and maybe a broker doesn't understand this whole concept that they just don't like taking a lot of risk.
Yeah, a lot of the time, the financial entertainers out there saying that, well, if you're in the market, you're going to get 8, 10, 12% every year. Yes, the S&P may do that over time, but if you have the appetite to be 100% in the S&P index going into retirement, you're probably not a client of Tony Walker Financial. So if that's what you're looking for versus a plan to use and enjoy your money without the fear of running out, go have fun. But if you're looking for a plan where you're not going to run out of money, that's where we come in.
I was going to say, are you online there, Wes? Can you see what the S&P did? Was it 2022? We had a little drop. I think it was 20. Yeah, we use an example. As we're looking that up, Wes. So I think speak to the fact, Heather, that also in retirement planning, it's a totally different world. When you're drawing money out, I know the fancy schmancy word is sequencing of returns, but for a layman to understand that, why is it so important that if you don't have to take the risk and don't have an appetite for it, what happens if you do continue to take risks? Now, all of a sudden, you're taking money out of that in retirement.
That's always a scary prospect. And of course, we've seen a lot of market volatility, the last several months, especially. And if you're drawing significant amounts down and the market is falling, it has a devastating impact on your overall plan in the future because your assets are just no longer there, and it's going to be much harder to regain those losses as you're drawing that down. So it's really important for us to be strategic on where you're invested, one, and then two, where we take your money from. So oftentimes we may feel like we need to switch that up a little bit or adjust things. But the nice thing is that we do try to meet everybody's income goals as far as their assets allow. I mean, it's really difficult, if the market drops 30% and then we call them and say, hey, maybe you need to just take 30% less from what you're normally withdrawing. And most people can't sustain that on, their monthly budget.
What'd you come up with, Wes?
Well, here's what I would say. So looking back in these returns, I just kind of looked at the most recent history. In 2019, this is the S&P 500. So this is a major market index. It's not one of our portfolios, but 2019, it did 31%, 2020, 18%, 21, 28%. But then in 2022, there's a negative 18% return. And then in the following years, there's double-digit returns in 2023 and 2024. But let's just say somebody entered retirement, just happened to be at the end of 2021. They said, okay, I'm going to stick it all in the S&P. If that person is not suited for that level of risk, they may have very well suffered an 18% loss, sold at the bottom, gotten out to then something that's fixed, and really cemented those losses. So I think that the key is to know your client personally, know what they'll be able to withstand, and then put them into a plan that makes sense. If you're just tossing money at stock indexes and you don't know what you're doing, don't know yourself and your way of your risk tolerance, it can get real messy real quick.
All right, you're watching the Worry-Free Retirement. Don't forget, the full-length episode of this interview, which lasts another 10 to 15 minutes, is on YouTube. You can check out all of our YouTube videos, youtube.com/Tony Walker Financial. We'll be right back.
Tired of the roller coaster ride of the stock market? Let Tony Walker show you how to smooth out the ride with your money. Log on to TonyWalkerFinancial.com and let's get started.
Who can you trust? It's one of the most important decisions you'll have to make. Question is, are you ready? Well, we're here to help at Tony Walker Financial. We care more about you than we do your money, and we have over 3,500 happy clients and an A-plus rating with the Better Business Bureau to prove it. Rolling over a 401k, confused about Social Security, maybe you're afraid of running out of money. Learn how to use and enjoy and protect your hard-earned money. Log on now to TonyWalkerFinancial.com and let's get started.
The individuals in this interview are uncompensated clients at the time of filming. Their opinions expressed were provided to Worry-Free Productions for use as an advertisement by Tony Walker Financial. Please refer to Form CRS and Form ADV Part 2B Disclosure Brochure for information regarding the advisory services offered by Tony Walker Financial.
Our client spotlight today features Mr. Garrett Bates and Miss Melody Bates. And so first of all, tell us a little bit about what you did for a living. We'll start with you, Garrett.
I was do the corporate grind for 25 years in the healthcare industry and focused on helping the organization run more effectively.
I'm an artist professionally. I do commissioned portraits.
And I understand you had a very big honor. Tell us who you were recently commissioned to do a portrait of.
Oh, well, I was honored to be chosen to paint the official portrait of Governor Beshear.
Can't believe the talent. I'm so impressed. Tell us a little bit about the experience in working with the staff. I'm very proud of the staff and just how we run things here and the operation in general.
That level of quality service and just personal relationship has been, really part of the whole experience for these last really 9 years.
To walk into your office talking about finances, it's more than that. And you're a finance guy, but you're also developed that relationship. You've asked, you always ask us, what are we doing and what's up in life? And, it's just,
you make sure that the financial things match up to the things that we're trying to do.
Looking for an advisor you can trust? Schedule your free phone call with Tony at TonyWalkerFinancial.com or call 1-877-499-9255.
Well, we hope you've enjoyed this new podcast format where I'm going to be featuring more and more staff at Tony Walker Financial. In fact, we have 3 more parts to this series about our investment philosophy at Tony Walker Financial, and we'll have on Heather, Trey, and Wes for all 3 of those parts. So we look forward to sharing that with you. In the meantime, if you'd like a second opinion on your finances, assuming you're retired or retiring soon, take advantage of something we call the free 10-minute fiduciary phone call, where you and I will talk briefly by phone. If we think we can help, you and I are going to meet in person to go over your situation and provide that free proprietary game plan. To take advantage of this free phone call, just log on to TonyWalkerFinancial.com, TonyWalkerFinancial.com, or call us anytime at 877-499-9255. Well, we hope you've enjoyed today's show. We look forward to talking to you next week on the Worry-Free Retirement. But between now and then, if all else fails, you be worry-free and you make it a good one.